Welcome to a special episode of The Market Story. We're taking a break from the structures and the rules to tell you a true story. The story of a shy, numbers-obsessed boy from Omaha, Nebraska, who bought his first stock at the age of 11 and went on to become one of the richest and most respected investors who has ever lived. His name is Warren Buffett, and hidden inside his story are some of the most important lessons in all of investing. Let's begin. Our story begins in Omaha, Nebraska, in 1930, right in the depths of the Great Depression, a time when money was scarce and times were hard. Warren Edward Buffett was born to Howard and Layla Buffett. His father, Howard, was a stockbroker, who would later go on to become a four-term United States congressman. And from a very early age, young Warren showed an unusual gift. Friends and family said he was a mathematical prodigy, a boy who could add up long columns of numbers in his head, just for fun. Numbers, and especially numbers tied to money, simply fascinated him. His entrepreneurial spirit showed up almost comically early. At just 6 years old, Warren bought 6 packs of Coca-Cola from his grandfather's grocery store, paying 25 cents for the pack. Then he sold each individual bottle for a nickel, 5 cents, pocketing a small profit on every single bottle he sold. It seems tiny. But think about what the 6-year-old already understood. Buy in bulk for less, sell individually for more, and keep the difference. That difference has a name we learned earlier on this channel: profit. The entrepreneur had well and truly arrived. Then came the moment that started it all. At 11 years old, Warren made his very first stock purchase. He bought 3 shares of an oil company called Cities Service at about $38 per share. He was now, officially, a shareholder. Exactly the idea we just explored in our last episode. But the story doesn't go smoothly. Almost immediately, the stock fell, dropping all the way down to $27. Imagine being 11 and watching your first investment lose a big chunk of its value. Nervous, Warren held on until it climbed back to $40, and then he sold, taking a small, safe profit. And here's the twist that haunted him. Not long after he sold, that very same stock soared to nearly $200 a share. And there it is, the first great lesson learned at age 11. Patience. Buffett later cited this exact experience as his earliest lesson in the value of patience in investing. He had been right about the company, but he sold too early, grabbing a small gain instead of waiting for the big one. Throughout his life, he came to believe that real investing wealth comes not from quick, nervous trades, but from buying wonderful things and holding them for a very, very long time. As he put it, the stock market is a device for transferring money from the impatient to the patient. Remember, this isn't advice to act on. It's the lesson the story teaches. But the young Buffett didn't just invest. He worked relentlessly. By the age of 13, he was running a paper route, waking up at 4:30 in the morning to deliver the Washington Post before school. He sold magazine subscriptions on the side. He even, at 13, filed his very first tax return and cleverly claimed his bicycle as a $35 tax deduction, since he used it for work, and he saved almost everything he earned. By the age of 15, he had saved up around $2,000, which is roughly $26,000 in today's money. And what did a 15-year-old do with it? He bought a 40-acre farm and rented it out to a farmer in exchange for a share of the profits. He was becoming an owner over and over again. This leads us straight to the second great lesson, and it's the one that built his entire fortune. It's the power of compounding, which Buffett himself describes using the image of a snowball. Picture a tiny snowball at the top of a long hill. As it rolls, it picks up more snow, getting bigger, and the bigger it gets, the more snow it picks up with each turn. Buffett reinvested almost every dollar he ever made, letting his money earn more money, which then earned still more money, year after year, decade after decade. Small amounts, compounding patiently over a very long time, become absolutely enormous. In fact, his famous biography, written by Alice Schroeder, is literally titled The Snowball. That's how central this single idea is to his whole life. As he grew up, two people shaped the investor he would become. First, at Columbia Business School, he studied under a professor named Benjamin Graham, often called the father of value investing, the idea of buying things for less than they're truly worth. Graham's thinking became the foundation of Buffett's entire approach. Then, in 1959, Buffett met a man named Charlie Munger, who would become his business partner and closest friend for the rest of his life. Munger nudged Buffett's philosophy in an important new direction. Don't just buy cheap companies, he argued. Buy wonderful, high-quality companies at fair prices and hold them. That shift led to Buffett's legendary investments in businesses like Coca-Cola and American Express. And that brings us to the third great lesson, captured in perhaps his most famous saying of all: be fearful when others are greedy, and greedy when others are fearful. What does that mean? It means the crowd's emotions are dangerous. When everyone is wildly optimistic and greedy, prices get pushed too high. That's how bubbles form. And when everyone is terrified and selling in a panic, good things go on sale cheap. That's where bargains hide. The disciplined investor learns to do the opposite of the panicking crowd, to stay calm and rational when everyone around them is losing their head. Mastering your own emotions, Buffett teaches, is just as important as mastering the numbers. So, where did it all end up? That 11-year-old's tiny snowball, rolled patiently down a very long hill, became one of the great fortunes in history. Through his company, Berkshire Hathaway, Warren Buffett built a personal net worth of well over $100 billion, earning him the affectionate nickname, the Oracle of Omaha. But notice what built it. Not a secret formula, not luck, not frantic trading. It was patience, the relentless power of compounding, and the discipline to stay calm when others panicked. The very same lessons that 11-year-old boy started learning with his first 3 shares. So, let's pull out the lessons hidden in the story. 1. Patience. Real wealth tends to come from holding wonderful things for the long term, not from quick trades. 2. The snowball. Small amounts of money, reinvested patiently, compound into enormous sums over time. 3. Master your emotions. Stay calm and rational when the crowd is either greedy or fearful. And a gentle but important reminder. This is the true story of a real investor, told to teach these timeless ideas. It is not investment advice, and it's not a suggestion to buy any particular stock. If you enjoyed this story as much as we enjoyed telling it, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow. Give it a like so more people discover Warren's story, and tap the bell so you never miss an episode. Next time, we're back to our journey through the markets. See you there.